Annetta, how big is rapid? How significant balance sheet shrinkage do you anticipate?
So, look, Brainard said pretty explicitly that there are going to be caps, which implies balance sheet reduction through runoff. She did not mention asset sales at all. And so I think the base case is still that, that they'll impose a cap of about $100 billion per month. That would be double the caps that we saw in the prior cycle. But that means that they'll only be able to reduce the balance sheet by about $1 trillion per year, right? So yes, it's a lot faster than the last cycle, but I think that type of a reduction is already in the price. So if that's the case, then we really didn't learn much new from Brainard today.
Yeah, so you think we could already be pricing in $1 trillion of balance sheet reduction every year. We're about $9 trillion right now. So maybe we're $8 trillion by next year, $7 trillion by the next year. The year after that, talk about the cap and the type of securities where we're seeing runoff. And even though this might be a status quo-y kind of announcement, we are seeing some steepening. What do they call it? Bear steepening today. What do you read into that?
So I think, what Brainard might be talking about, because she does seem to be assuming quite a bit of tightening through the balance sheet this year. We had pegged her for someone in the 6 to 7 hike camp prior to today. So either, and she said she wants policy to be basically at neutral this year. So either she is a lot higher in terms of hikes than we anticipated, or she does expect much more tightening to come through the balance sheet. It's possible that she's assuming that, even though they shrink the balance sheet at $1 trillion per year, that the market is just going to sort of front run the next several years of reduction. And she did point specifically at the mortgage market, where I think you could easily say that that's in fact what has happened. The 30-year mortgage rate is up something like 160, 170 basis points year to date, and that's clearly the market front running the idea that that side of the Fed's portfolio will be running down.
And look, if I'm the Fed, I might say this is exactly what I want to achieve. I want to slow the housing market so prices aren't up 20% a year. I want to steepen the curve. And investors have been debating how much is going to be rate hikes and how much is going to be balance sheet. I know you've been saying, Annetta, they might have to be more hawkish than what's already priced in. So what is the mix, you think, between more rate hikes, more balance sheet?
So I think it's going to be a little bit of both. I think for now, runoff is the base case, right? With a $100 billion cap, again, that gets you to about $1 trillion per year. I do think asset sales are potentially on the table. I think the conditions for going to asset sales would be if prepay speeds on the Fed's mortgage portfolio slow to something like 10%. That would mean that the mortgage portfolio runs down by about only $20 billion per month, and that's going to asset sales. But they're going to have to supplement that regardless by a pretty steep rate hike trajectory as well.
Yeah, and even though we have players in the mortgage market warning, there's not, a big appetite to take down a lot of supply. So they're facing a conundrum. They could even face losses on some sales of the MBS portfolio at the very short end. So there are many more chapters still to this story. Annetta, we'll leave it there. Thanks for your time today.
Shepard Smith here. Thanks for watching CNBC on YouTube.